Financial markets are heavily regulated against abuse, which could take many forms. Insider trading is but only one way that individuals could abuse financial markets for personal gain, or sometimes just out of malicious intent. So, what gives rise to insider trading? Information about an organization takes time to reach the market, and in many cases, information is withheld and only disclosed to the market at an appropriate time. This creates an information gap. People working within the organization who are privy to this information need to be careful of insider trading during the period when an information gap exists. So what is needed for insider trading to occur? Inside information is the first requirement. Two criteria need to be satisfied for inside information to exist. That is, there needs to be actual information which could take the form of minutes of board meetings, confidential discussions, or even rumours. The second criteria is that information is not yet public knowledge. For example, the Chief Operating Officer of Mining Limited and a senior manager had a discussion about a government gazetted exposure draft of a potential new mining law. If the law becomes effective, it would result in significant limitations on the production and output of Mining Limited. This would negatively affect profits and share price. Would this be considered inside information? The potentially new law is information that exists and it relates to the company, so this criteria is satisfied. However, the exposure draft of the potentially new law is public knowledge since it has been published in the Government Gazette. Therefore, the second requirement has not been satisfied. Accordingly, the exposure draft of the new law is not considered inside information. However, the potential effect of the new law on the production and output of Mining Limited, as well as the predicted effect on the share price, could be argued to be inside information if the general public cannot discern such information themselves. In other words, if the discussion related to some confidential information about potential effects which a reasonable and informed third person outside the organization would not know or would not be able to deduce themselves until further disclosures were made, then such discussions would be considered inside information. The existence of inside information in itself does not give rise to insider trading. For insider trading to occur, this information first needs to be disclosed or used such that it is still not yet in the public knowledge. Further, the disclosure or use needs to have an impact on the share price, and it would influence the buying or selling decisions of investors. For example, Ben was part of a board meeting to consider the selling of a major segment of XY Limited. He discussed this with his wife, who then immediately sold all her significant shareholding in XY Limited, which in turn caused the share price of XY Limited to decrease significantly. The consideration to sell a major segment of XY Limited is considered inside information because it is actual information about a likely event, and it is not yet public knowledge. Ben disclosed this information to his wife, who he knows is a major shareholder. This inside information then influenced his wife's decision to sell, which caused the share price to decrease. Thus, the inside information led to insider trading. To recap, insider trading is one way that individuals abuse financial markets. For insider trading to exist, there must be inside information that was disclosed or used in a manner that materially affects share price.